What's going on, everyone? In this week's housing market update, I've got some exciting data and stories about many of the things I've been talking about for months now, finally starting to come to fruition. And I've got a lot to go over today, so let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest information in the economy so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. So please, if you haven't already done so, subscribe to the channel and hit that bell so you don't miss out on the data and tips keeping you ahead of the market. And I've got some great info for you today, so let's dive on in. All right, so starting us off this week, let's get right into the 7-day market update. We got some really good news here this week. New listings went from 715 last week to 818 this week. That's up 14%, and that's up over 100 new listings coming on the market. So that's really good news for buyers. On the other hand, for sellers, it looks like to me that with the federal interest rate hikes appearing to be starting this Wednesday, the 16th of March, it looks like sellers are starting to make a little bit of a rush to get their homes sold. I would assume that comes down to a fear of the market shifting or changing with interest rates increasing and buyers starting to cool off on looking with those interest rates and affordability starting to get out of reach. So I think that probably has something to do with it. But we'll have to keep an eye on the trend and see if that does change or continue going up over the next several weeks. Solds went from 721 last week to 806 this week. That is up 12%. So we have a net gain of 2% this week from solds to new listings. While that is up significantly, we do see that there are more listings coming on the market. So that's really good news. Pendings are also up. Those are up 7% from 1244 last week to 1337 this week. That just goes to show you new listings coming on. If there are more new listings, you would expect more pending sales to go under contract as well, since there are more listings for buyers to choose from. Total inventory breakdown. So we went from single families last week 1867 to this week 1981. So that's 114 new listings in the single family homes. Condos. This includes manufactured homes, townhouses, as well as obviously your typical condos and villas, things like that. Last week we're at 851. This week we're at 936. That's a gain of 85. So we have a net gain this week in the residential sector of 199 new properties listed in the market. Again, many of those are going off the market just as fast as they're coming on the market, but that's good news to see that more listings are coming on the market. I expect that we are going to be seeing that more as the interest rates start to go up and increase. Multifamilies, last week we were at 75. This week we're at 73. That's a loss of just 2. And then foreclosures are again up. Last week we were at 26. This week we're up 31. That's a gain of 5. One of the stories this week that we're going to be covering is foreclosures, so we'll talk about that in a little bit. Now let's take a look at the month-over-month growth. So the new data for February is out. So let's take a look at this. The trend line for homes for sale. As you can see, the trend line has continued to decrease again. Quite a large decrease month over month from last month, actually from January to February. So that's no surprise. The homes for sale continues to decrease. That is just a trend we've been seeing for the last 2 years. New listings. This has a slight uptick over last month. So this is the comparison. The slight uptick is from January to February. We are now starting to see a significant amount of homes coming on in March. So I expect when we look at this data next month, we're going to see a pretty large increase in this graph as well for this past month. Closed sales, that also has ticked up. Again, this is, I believe, a combination of the number of buyers who are rushing to buy before interest rates go up and they get priced out of certain pricing categories for homes, as well as sellers are starting to list more homes, so that provides more inventory. Buyers have more options, so I would expect that closed sales would increase, and I think we're going to see that increase next month as well. Average sale price. So this one was starting to head down. We did reach a peak right about the 663,000 2 months ago in December. Then in January, we saw it did decrease a little bit. And now in February, we saw that it did go back up a little bit. Even though you can't really tell too much from the graph, it is still below the peak. So while it did go up, it is still below the peak. So we'll have to keep an eye on this and see if the sale price continues. I would expect it not to. And I think that when we take a look at this next month, we are going to see that falls quite a bit. Shows the pending. So this is a good indicator of how many. So this is just to break it down is showings. How many showings does it take for a home to go under contract? This really doesn't look like it's that much. It went from 10 to 12 month over month, but 2 extra showings on average is a significant increase compared to what we've been averaging over the last 6 to 12 months. So it is taking more showings for a home to go under contract. I think that comes down to one, just buyer sentiment right now. A lot of buyers are holding off and they feel like it's not a great time to buy. That is not an opinion. That has actually been surveyed. Several different surveys have showed that buyer sentiment is down right now. So the fact that this is showing that it is taking longer for a home to go under contract is just indicative of that sentiment. Days on market. So this has gone down a little bit. It's about 23 days on market on average for homes. That is across the board. So that does include for sale by owners as well as your traditional MLS listings. So it's really staying about 20 to 23 right in that range. And even though it did decrease slightly 2 months ago in December to January, it's about the same in February to January. So I do expect that this will probably increase. Days on market will increase in March when we get that new data next month, but we'll have to keep an eye on this as well. All right, new interest rates. As of yesterday, the interest rates for the 30-year fixed mortgage went from 3.941. That was 2 weeks ago. It did decrease a little bit. I think it went down to about 3.86. And then this week, it is back up to 4.18. So we're back over the 4% range. And I expect as of Wednesday's announcement of the Fed, I think that we will see interest rates for mortgages start to continue climbing. Bank rate had it going from 4.25 to 4.32. So that is 7 basis points up. Again, still over the 4% range. And I will expect that to continue rising as well with new developments. So let's get right into the trends in real estate, the micro versus the macro. Today, we're going to be looking at the CPI data release that just came out last week. And no surprise, inflation is up. But we also are going to take a look and listen to Powell's hearing that happened on March 2nd and 3rd and what he had to say about the inflation and their next steps. So CPI, we are at now 7.9%. This is significant because the last time we got the CPI reading, it was only up 0.6%. This time it's up 0.8%, which shows that inflation is starting to multiply. It's quickening. So we're getting more increases. And this data does not take into account the recent hikes in gas. And this new way that they do the CPI calculations does not calculate for home prices, which have been skyrocketing over the last 2 years. So this CPI does not figure that in there. It also doesn't include the rent, at least not the way it should be done. It does include rent, but it's based on a survey of homeowners, which most homeowners, they don't have a real pulse on what the rental market is. So when you ask a regular homeowner, what do you think you can get for rent? It might not even be close to what the actual market is dictating rent is right now. So a better way to do that would be to actually survey rental owners or investors to see what their rentals are, but that's not how they do it. So the CPI, the new way that they do this, does not factor in a lot of significant factors of what the CPI really is. That's why a lot of people have been saying that the CPI is probably closer to 15, in between 15 and 20% right now, if you do it based on the old way of doing it. So it is 0.8 plus increase this month, and we'll have to see what happens next time. So we're going to take a look at right now at Powell his hearing on March 2nd and 3rd, he was directly asked if he was willing to take the steps that were required to tackle inflation and keep price stability, as Volcker did in the 70s. So let's take a listen and see what he had to say about that and his questioning. It was a little bit funny.
A lot of it was draconian. You have to do it. Is the leadership at the Fed under you and the Fed prepared to do what it takes to get inflation under control and protect price stability?
Well, let me say I knew Paul Volcker. I'm pretty sure I saw him testify in this room many years ago. I think he was one of the great public servants of the era, the greatest economic public servant of the era. And I hope history will record that the answer to your question is yes.
So you're prepared to do what it takes without any reservation to protect price stability?
Yes.
That would be a departure of what you've done.
One of the other stories, when I went through this, it was about a 3-hour hearing, so it did take me a while to watch the video, but I did get some nice clips. So this one came out of March 2nd. It was actually FEMA future flood concerns. Mr. Kasten was asking Powell about some issues going on with global warming and concerns about coastal floodplains, and how that was going to be affecting homeowners versus the government, who was going to be picking up the tab if the sea levels did rise. So let's take a listen to what they had to say on that.
Some of the questioning of my colleagues and some of the debates around confirmation of your colleagues around climate change. The IPCC report that came out last week said climate change effects are outpacing our ability to adapt. We're seeing communities that sort of simultaneously have droughts, floods, and fires, and money is moving in surprising ways. We've seen, personally, I've seen stories just in the last month of one coastal community where the roads are being washed out that haven't yet paid off the bonds that were used to pay for the road, and they don't know how to reconnect those communities. Another community on the coast where the mayor is sitting there realizing that one neighborhood he can afford to build a seawall, and in another neighborhood it's cheaper to relocate people, and dealing with the political fallout of that decision. We have massive political risks that are coming, and we know they are coming because the laws of physics do not care how we vote. And I'm concerned by your response to Mr. Posey when you said that I think you said we've not even done the scenarios yet, excuse me, on the climate change. And I understand these are complicated, but if those scenarios haven't been done, I want to start, if we don't deal with the financial fallout, the political fallout's going to be far worse. And so I just want to start with a very specific question. NOAA and NASA came out with a report, I think last week or 2 weeks ago, saying that Florida is looking at 12 inches of sea level rise in the next 10 to 20 years and 18 inches by 2050. That means that there are whole communities in Florida where there's going to be complete property loss before a 30-year mortgage is repaid that was issued today. Are Fannie and Freddie changing their lending standards in response to those risks in those communities in Florida and elsewhere that are now within 30 years of being unable to repay those notes?
I don't know.
I asked the question there because in the CFTC report, Managing Climate Risk in the Financial Sector, came out about 2 years ago. They noted that the higher an area risk for coastal flooding, the more likely the commercial banks are to be offloading their risks onto Fannie and Freddie. And so if the sophisticated players in the system are seeing this risk and we are at a federal level are backstopping, how are we isolating our federal balance sheet from that risk exposure?
I think that's a very likely outcome, actually. I think as private lenders will move away from that, and will the government force people to move away from the coast, or will they wind up government, that's us, wind up picking up the tab? More likely the latter.
So going hand in hand with that, there actually was an article in the National Association of Realtors for Florida. It was the FEMA flood map concerns, and North Carolina State University used AI to predict potential flood damage and found 790,000 square miles have a greater risk than FEMA identifies in its maps. So that's a significant amount of land, and it's all at the the coastal areas. So going back to the hearing, the questions that were being asked is who is going to be picking up this bill if all of a sudden the sea levels do rise, and you have all of these homes that are on the coast that are going to be basically flooded and underwater, or not livable in the areas that they are within the next 10 to 20 years, or at least the next 30 years, where they have mortgages on them, which are usually 30-year mortgages, and may not be able to actually pay that note off. Who is going to be picking up the tab on that? So Powell alluded to, it sounds like it's probably going to be the government picking up that, because we're basing these, these insurance policies and things like that based on the government stipulations and regulations and FEMA. So for more than 1 million square miles of land across the United States across a 14-year period, this study was done. That was more than 790,000 square miles greater than flood risk zones identified by FEMA's maps. And this is alluding to the 100-year floodplain, which anybody who has talked to me or any agent who covers the flood insurance and talks about flood insurance with their with their clients, the 100-year floodplain down here is the most it's the most at-risk area. So it usually requires the highest premiums that you would get down here. I think if you're doing it in a number scale, which is used elsewhere, I believe that would be a factor of 10. So it's the most at-risk area for flooding. And that a lot of other areas like the 500-year and sometimes, the X zones in the state of Florida, were very close to sea level almost throughout the state. So, but they do have different zones. An X zone does not need to have mandatory flood insurance because it's not in one of those high risk 500 or 100-year floodplain zones. So, the question goes back to who is going to be footing the bill if these locations do end up having issues with flooding later on. Another data, so this goes back to what I had mentioned earlier. The U.S. foreclosure activity in February 2022 continued to increase steadily. So February foreclosure activity looks a lot like what we can expect to see for at least the next 6 months. This just goes back to those moratoriums being lifted, and now foreclosures are starting to happen on a more regular basis. They are jumping up each month because more and more people are able to be, more and more people are going into foreclosure and are being able to be acted on those properties. So double-digit month-over-month growth and triple-digit year-over-year increases, said Rick Sharga, executive president of Realty Track and Adam Company. They are the kind of the leader in data for foreclosures. It's simply the gradual return to normal levels of the foreclosure activity after 2 years of artificially low numbers due to government and industry efforts. This is something I've been saying for quite a while now. We paused those foreclosures for almost 2 years now, and that's a whole bunch of inventory that wasn't able to make it to market. We are now going to start seeing that inventory make it to market. So I think that is also going to have, in conjunction with the interest rates, in conjunction with the inflation issues, in conjunction with the stock markets now entering into bear territory and having death crosses on the 200-day moving averages, we're starting to see it's almost like a perfect storm is starting to shape up. We'll have to keep an eye on it, but these are all the things that I was mentioning that are going to be risks to buying and selling, depending on which side of the equation you're on. But now we're starting to see a lot of this stuff play out. So we're going to have to see, what the Fed does and how they're planning to do their soft landing, which, in my opinion, I don't think they can really, create a soft landing. I think they're going to have to put us into a recession. And that just comes along with, what we've done with, printing money. It's not really printing money, but printing money, giving out money, and, propping up the economy over the last 2 years when it really should have already started to head the other way, and was prior to the pandemic. The markets were starting to look like they were heading into a bear market. Then we had the pandemic and the markets got propped up with a lot of stimulus. The foreclosure starts increased monthly in 40 states, including the District of Columbia. Lenders started the foreclosure process on 16,545 U.S. properties in February 2022, up 40% from last month and 176% from a year ago. So that's expected. But what you do want to know or pay attention to is Florida, 1,527 foreclosure starts, was actually in second place right behind California. No surprise, it is one of the larger states. So, it would just be natural that California, Florida, and Texas, the largest states, would have the most starts in foreclosures. So we will keep an eye on that. And as I've been updating you each week, foreclosures in our area. Another story that we touched on before, Better.com is again in the news. They had laid off 900 employees over a Zoom chat, really unprofessionally done. This time they're laying off an additional 3,000 more employees. So if you're not familiar with Better.com, they are a mortgage lender. They are an online mortgage lending company. This is something that has been kind of playing out for quite some time now. The mortgage industry is expecting a real significant slowdown. They have been laying off people. It's not just Better.com. A lot of other companies have as well. Some lenders really haven't been talking about it too much, but it's part of the cycle. And with us, with interest rates starting to go up, it's probably going to mean more layoffs and less business in the refinancing and new mortgage applications. So, all right, that kind of gets us back to where are we at with the wall of worry. Keeping an eye on these things, inflation, hyperinflation to 10%. I really think, we should have seen 10% already. It just the new CPI data hadn't taken into account the new increases in gas. So I would expect we're going to be seeing that sometime in the next month or two. Hyperinflation, the other worry right now is stagflation, where we're starting to get a combination of a bunch of different, a bunch of different things are starting to happen. The Fed, and we also have the stock market, and and the war in Russia and Ukraine. All these things are starting to come together. So the worry right now is more stagflation versus hyperinflation, where the economy just really slows down and we're heading into bear markets across the stock market. So it could be, it's looking more and more likely that we're going to be heading into some kind of a recession in the next year. Federal Reserve rate hikes, that is this Wednesday, March 16th. They will be announcing what they're planning to do. Originally, it was 50 basis points. Now it's looking more likely that it's going to be a quarter, so 25 basis points because of what's going on in Ukraine and the oil issues. Mortgage rate increases, I would expect those are going to go up alongside the Fed's rate hikes and quantitative tightening. Stock market crashes and corrections, we're down 20% in almost all the markets right now from January. So we're starting to head lower. And in bear markets, if you're paying attention to the stock market, a bear market usually has rallies. So it will head to a new low, a lower low, then it goes up to a higher low, a lower high, then it goes down to a lower low, and it keeps going in a channel downward. It can take 2 or 3 years for it to play out completely. Many people have predicted at least another 20% drop in the stock market. Some are calling for 50 to 80%, which would bring us back to basically the dot-com bubble type of a crash or a bear market. And then, the thing that comes along with bear markets, with the stock market and things like that, recessions, the big thing is going to be job losses. I know the job numbers have looked really good over the last several months or the last couple times that they released them, but you have to remember we lost over 2 million jobs when we had the pandemic. So the fact that we've had some really good numbers over the last several months, we're really just starting to get back to where we were pre-pandemic. So now we're worried about, what's going to happen with the market. Does this go into a recession where we lose jobs again? And when that happens, it's almost like a domino effect. People losing jobs means they can't afford. Usually the next thing to go is assets. What were the additional assets? Those luxury items, those luxury properties or vacation properties, those get sold, brings more inventory, and then it's a trickle-down effect throughout the entire economy. And then obviously we got to pay attention and see what's going on with the Russia war, what's going to happen with China, Taiwan, see if anything happens there. China's in the middle right now. U.S. is pushing for them to sanction Russia. Russia is asking for China's help with the war and the sanctions. So we do have to keep an eye on all these things. But other than that, this is just what I think about the market. Tell me what you think about the market in the comments below. I'd love to hear what your thoughts are and where you think we're headed, and what you're planning on with investing, buying, or selling in the near future in our local market here. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.